Hello again, and welcome to the third and final in our series of 3 webinars on the new Charities Statement of Recommended Practice, or SORP. My name is Euan Morrison, and I am Head of Charities at Chiene and Tait. In this last session, I'll speak about changes to the balance sheet and the notes to the accounts under the new SORP. As I mentioned in the last webinar, the accounting framework that applies within the UK to all entities, not just charities, is UK Generally Accepted Accounting Practice, and this has recently changed with the introduction of Financial Reporting Standard FRS 102. And with this change has come the need to update the various specialised areas of accounting. As a result, we have a selection of new SORPs to deal with, the key one for the charity sector, of course, being the Charities SORP. The new SORPs apply to accounting periods commencing on or after 1st of January 2015. So if you have a December year end, the December 2015 accounts are those which will be first affected, with the comparative figures restated for consistency. The first day of the comparative year, i.e. for December year ends, the 1st of January 2014, is what's called the transition date. And it's from this date that any changes to balances required under the revised accounting treatments must be calculated. We have 2 different versions of the charity SORP, of course. The FRS 102 SORP is available to all charities, regardless of size, but if your charity's figures exceed the small company limits in the Companies Act, you must apply this version. The current small company limits are a total income of 6.5 million, gross assets of 3.26 million, and 50 employees. Where you are below these limits, you may alternatively report under the Financial Reporting Standard for Smaller Entities, or FRISI, version of the Charity SORP, but you can't pick and choose between the 2 versions. You must apply all the relevant requirements of the SORP version you select. Also importantly, the FRISI version of the SORP will only be available for 1 year, as the FRISI on which it is based is being withdrawn for accounting periods commencing on or after 1st of January 16. So we'll now look at the balance sheet and the key changes from the current charity SORP, focusing on the FRS 102 version of the SORP. Where the FRISI is different, I have added notes to the slides to indicate this. Unlike the Statement of Financial Activities, in general, you're not likely to see much difference in how balance sheets will appear in terms of layout and headings under the new SORPs. There are, however, changes to how we account for fixed assets, more on which later. Accounting treatments for specific types of liability will also change, some of which we touched on in the second seminar, where the requirement to take into account the time value of money becomes important. And finally, in respect to the balance sheet itself, there are provisions which provide one-off options when moving from the old accounting regime to the new one. So let's start with heritage assets. Heritage assets are those assets which have historical, artistic, scientific, geophysical or environmental qualities, and they are held and maintained for the contribution to knowledge and culture. I tend to think of them much like an elephant. Difficult to describe, but you'll know one when you see one. Previously, there had to be an explicit link with the charity's objects for an asset to qualify as heritage, but now it just needs to meet certain conditions related to the description above. In practice, what this means is that charities without preservation or conservation purposes may now be able to account for certain assets as heritage. The recognition and disclosure criteria are similar to before, and there is more detail set out in the separate module in the SORP. Another asset class some charities will have is that of investment properties, and investment properties are those that are held for a financial return, either in the form of rental income or capital appreciation. There are some changes to how we value these, but let's start with the basics. On the left-hand side, we have the old requirements, and these state that valuations should be at market value using any reasonable approach, and that they should be carried out at least every 5 years. Under the FRS 102 SORP, the valuation is now based on fair value, which in practice is likely to be the same as market value. You now also have to note whether an external valuation has been carried out, but there's no particular stipulation as to how often this should be performed. Continuing with investment property, there are a couple of points that may result in how charities currently account for this category of fixed asset. First applies in the case of properties that are held both for the charity's own operational use, but also where an element of the property provides a financial return. The old SORP stated that such properties could be accounted for based on the main or the principal usage, and this simplified the accounting considerations. Under the new SORP, however, charities must apportion the property usage when looking at how to account for it. If we take the picture on the screen as an example, if the lower 4 floors were used by the charity for its own purposes, but the top floor was let out, the top floor will now have to be accounted for at fair value as an investment property. The rest of the building will be accounted for at cost less depreciation, or whatever the existing policy was, within the tangible fixed assets. The only concession from this requirement is if the investment element can't be measured reliably without undue cost or effort. The other change with investment properties applies in the situation where you have a group and you let a property to another member of the group. Now, this is not uncommon where a charitable parent might let out premises to, perhaps, a trading subsidiary. Previously, the property let would be accounted for on the basis that it was an asset of the overall group, i.e. as a tangible fixed asset, most often at cost less depreciation, rather than as an investment at fair value. The new FRS 102 SORP requires such properties to be accounted for as investment assets in the parent charity's own balance sheet. And this is despite the fact that when we consolidate the balance sheets, the let property reverts back to being a normal tangible fixed asset. The result of this will be that, rather confusingly, within the same set of consolidated accounts, the group balance sheet will have a different treatment from the parent charity's balance sheet on the adjacent page. As I mentioned previously, there are certain options when transitioning from the old SORP to the new FRS 102 SORP, and these derive from the Financial Reporting Standard 102 itself. Here we will look at those relating to property carrying values. Where property, plant or equipment is currently carried at valuation, there is the option to lock the carrying value as if at cost, based on a fair value valuation at the transition date. And this would have the advantage of not requiring to undertake regular valuations going forward and resorting instead to a deemed cost and annual depreciation charges. The other option would be to lock the carrying value as if at cost based on a valuation performed at or before the transition date. Social investments are a new term for what were previously called program-related investments, i.e. those made by a charity that are associated with its charitable objectives rather than being purely for an investment return. So there are now two categories of social investment. The first of these is program-related, which is deemed to be where the financial return is incidental to meeting the purposes of a charity. The second category is mixed motive, and that's where there's a dual purpose, i.e. the return element ranks as importantly as the charitable purpose. These investments must be disclosed separately either on the balance sheet or in the notes, and there are specific methods for valuing them which are set out in a separate module of the SORP itself. Pensions are of course a big issue for the sector just now, with liabilities and commitments unfortunately ever increasing. In respect of the first two categories of pension, and these are defined contribution schemes where the costs just reflect what is paid into the scheme to the year, and the other being final salary or defined benefit schemes where the employer's share of the assets and liabilities are already fully accounted for in the balance sheet. For these two categories, there are no real changes. Where there is a big change is in relation to defined benefit multi-employer schemes where the liability is not already on the balance sheet. The reason these liabilities are not already on the balance sheet is usually because the scheme can't segregate the assets and liabilities between the various employers involved. This in itself doesn't change, as if the deficit can't be measured, it can't be recognised. If, however, an employer in such a scheme has an agreement in place to make up past service deficits by making additional contributions, the total of these extra contributions must be totted up and taken on as a liability. As you can imagine, these amounts can be quite sizable, and this may cause quite a significant dent in the balance sheets of charities in this position. And to further complicate matters, it's the present value of the total contributions that is accounted for, again involving discounting for the time value of money where that's material. The next slide is of most importance to charities for whom grant making is a material part of what they do. The key changes relate to grants paid to institutions rather than individuals, and in respect of such grants, details of the grants now need to be included in the notes to the accounts, the trustees report, or via the charity's website, provided that there is a clear link to this set out in the accounts. It's no longer permitted to exclude these details and state instead in the accounts that they're available in a separate publication from the charity's office. There are a couple of changes to how we deal with leases under the new SORPs, and in this case we're talking about operating leases, e.g. buildings or photocopiers, rather than finance leases or hire purchase. Where you have benefited from a lease incentive, such as a rent-free period, under the new SORP, you must spread the benefit over the full period of the lease and not just up to the first breakpoint as at present. There are, however, transitional provisions such that if the lease is signed before the transition date, you can keep your existing policy. Staying with leases, and this is purely disclosure related with no changes to balances being required, you now need to disclose the future lease payment commitments on the basis of when they are due under the lease. And this is instead of just disclosing the annual commitment split into categories depending on when the lease expired. The final point in leases is that it's no longer necessary to show these commitments in respect of property separate from others. You can just combine the disclosure. There are a few final flourishes in terms of changes to figures disclosed, and we'll just cover some of these briefly below. The first one to highlight relates to remuneration, and this is something that has become more topical in the voluntary sector in recent times. For those who fall into the category of key management personnel, and these are defined, if you remember from the first webinar on the trustees report, as those who have authority and responsibility for planning, directing and controlling activities of the charity. For this category, the aggregate remuneration should now be disclosed. Within this category, you would most likely see trustees and directors, if remunerated, the chief executive, and perhaps other members of the senior management team, depending on how the organisation is run. Other staff-related disclosures that must be specifically included now are redundancy and termination payments. The final additional item to mention, which must now be disclosed, is the aggregate of donations made by trustees during the year to the charity, even if these donations are unconditional. Another interesting point is that the amount of expenses waived by trustees now need to be disclosed if it's material. Trying to establish the amount of the waived expenses and whether they are material is of course a bit more difficult. Well, we've now come to the end of our review of the main changes brought about by the charity SORPs, and clearly there may be a lot to think about depending on the type of charity you are, what sort of assets and liabilities you have, and the nature of your income and expenditure. If you're not already well down the path of preparing for the changes, I will just highlight a suggested plan of implementation which you may wish to consider. To start with, ensure that the key people in the organisation are aware of the changes. what the potential impacts could be, and when they will take effect. And that this should include the trustees as well as senior management and the finance team, as it's important that everyone takes ownership. Next, confirm timetables and provide both the time and capacity for the additional work to be carried out. Even if you're using a third-party advisor to assist with the restatement, it will require input from your staff, and work should ideally be planned to be completed in advance of the busy year-end accounts and audit cycle. There are, of course, two options with regard to the SORP depending on the size of your charities, but if you take advantage of the frizzy SORP, remember it will only be available for 1 year, and perhaps you may prefer not to make two changes to your accounts in 2 years. Having agreed on your SORP, you'll need to obtain a variety of information in a different format from before, and examples of this would be holiday pay, or perhaps looking at income that was probable at the year end. You might also need to obtain valuations of property which you did not have previously, and you will have to draft up new parts of the trustees report to cover things such as key management personnel remuneration policies and principal risks and uncertainties. It may even be necessary to get data out of archiving where it relates to previous years. A helpful output from all of this preparation work would be either a version of your prior year's accounts restated under the new SORPs, or alternatively a template set of accounts for the first year under the new SORP, with the comparative figures redrafted under the new rules. And this would then allow the trustees and senior management to understand more clearly the impact of the changes, and where necessary, plan to communicate anything of significance to users of the accounts, such as funders, regulators, or beneficiaries early on in the process. For more detailed information on new SORPs, the SORP making body has created a very good website, and this allows you to download copies of the SORPs and has example accounts, which now include some specifically for Scottish charities. It also has very useful help sheets, one of which sets out the main changes from the 2005 SORP to the new FRS 102 version. And finally, as ever, we at Chiene and Tait will be very pleased to assist you with your transition to FRS 102. I'll bring this to a close now, but I do hope that this series of seminars has been helpful, and if you have not seen them, the first two, which cover the Trustees Report and the Statement of Financial Activities and Accounting Treatments, remain available to watch on our website.